we need to still look at one of the a few cases that deserve a special attention, and that's those cases that we call special situations. We can group them into categories, but before doing that, let's listen to our usual short video.
All right, let's jump right in. Today we are tackling one of the most exciting and, let's be honest, one of the most dangerous corners of the market: special situations. We're talking about those huge corporate shakeups that promise incredible returns, but can, just as easily, completely wreck a portfolio. So the big question is, right? Are these a massive opportunity, or are they just an elaborate trap?
And you know, this quote from our source material just nails it. It perfectly captures that tension. On one side, you've got the incredible glamour of a potential jackpot. But on the other, you have this messy, complicated tangle of risk that is super hard to figure out. And that's exactly the conflict we're going to unpack today.
So why do we even care about these things? Well, the pull is really strong. Come on, we've all heard the stories, right? IPOs that just explode on day one, or a takeover deal that hands shareholders this huge premium overnight. It feels like a shortcut, like hitting the financial jackpot. So what exactly falls under this umbrella of special situations? Well, we're really looking at four main types, where the normal rules just don't apply. You've got a company going public for the first time, an IPO. You've got a struggling business trying to pull off a dramatic turnaround. Then there are corporate spin-offs, where a big company carves out a piece of itself. And of course, the big one, mergers and acquisitions. Each one of these has its own unique playbook and its own hidden traps. And this, right here, brings us to the absolute heart of the problem. What happens when the standard tools you rely on to analyze stocks just break? When they stop working? In these special situations, the financial models, the metrics that we all learn, they suddenly become unreliable. And that's where things get dangerous. So here's the most important thing to get. That trusty spreadsheets you built, all your PE ratios, your discounted cash flow models. In these situations, they're not just a little bit off, they are actively, dangerously misleading. It's like you're trying to play chess using the rules for checkers. It's a recipe for disaster.
To really understand why, we've got to get into the weeds a little bit. So think of this next part as a guided tour of the minefield. We're going to look at the specific dangers that are hiding inside each type of special situation.
Okay, first up, IPOs. Our source material calls them the market's debutante ball, which is just a perfect way to describe it. They're new, they're glamorous, everyone's talking about them. But what's the real problem? They have virtually no public history. You're basically investing in a story, a promise of what's to come. And this slide really breaks down why they're so hard to value. I mean, with almost no real operating history to look back on, you're pretty much forced to rely on the company's own projections, which, let's be real, are usually incredibly aggressive. And the initial price, that's not based on the company's actual worth. It's driven by hype and what the investment bankers think they can sell it for. Now, if IPOs are all about betting on a shiny, unknown future, turnarounds are the complete opposite. They're about betting against a known, really troubled past. It's the ultimate contrarian dream, right? Find a company that's been beaten down, buy it cheap, and ride it all the way back up. But in reality, it is an absolute minefield. And here's exactly why it's so tricky. The company's old financial statements, they're a total mess. They're all distorted by losses, which makes them useless for trying to predict the future. Your entire bet comes down to one thing. Can the management team actually pull it off? It's a pure bet on people, not on numbers, and all the while, the company could be burning through cash and heading for zero. Next on our tour, spin-offs. This happens when a huge company decides to take one of its divisions and turn it into a separate, brand new public company. And the pitch you always hear, every single time, is that this is going to unlock hidden value for everyone. But here's the billion-dollar question you have to ask yourself. Is the parent company really setting some amazing asset free to flourish on its own? Or are they just strategically dumping a struggling part of their business, maybe even loading it up with a ton of debt on its way out the door? One is a brilliant move. The other is a trap. I mean, just look at this chart for a second. That wild, chaotic purple line, that's the brand new spinoff. How in the world would you even begin to analyze that? It has no financial history of its own, its stock price is all over the map. This is the perfect example of why this kind of thing isn't for amateurs. It's a job for a specialist, for a forensic accountant.
And that brings us to the last one, mergers and acquisitions. The moment a takeover deal is announced, the game completely changes. The stock price of the company being bought doesn't trade on its earnings anymore. Nope. It starts trading based on what the market thinks the odds of the deal actually closing are. The fundamentals get thrown out the window.
So if all of our normal tools are broken, how does anyone successfully navigate this world? Well, the pros, they're not using our tools. They have their own secret weapons.
And this is the key difference right here. A retail investor is looking at a PE ratio. A professional specialist, though, is looking at a totally different set of data, using tools that were built specifically for these messy, chaotic situations.
So for example, specialists might use a system like Seductive, which has ratings designed just for M&A deals. Instead of looking at a normal stock screener, they're looking at something like an SMX rating that literally calculates the statistical probability that a company will be a takeover target. Or they're using an SME rating to figure out if a buyout offer is actually a fair price for shareholders. This is just a completely different universe of analysis. And here's another one, a pro-level indicator that most of us just kind of ignore. Goodwill. You see it on the balance sheet, and it's basically the extra price a company pays when it buys another one, for stuff like brand name or customer relationships. But see, by tracking a company's goodwill, a specialist can see its entire history of deals. Is the company's growth real, or did they just buy it? A huge amount of goodwill can be a massive red flag that management has been overpaying for its acquisitions, which can signal big problems down the road.
So, after our little tour of the minefield and getting a peek at the specialist toolkit, what's the final verdict? Should most investors even bother with special situations? Well, the conclusion from our source material is pretty blunt. The professionals just have more information, they have better tools, and they have way more time to do the incredibly deep research that's required. For everybody else, this gap, this information asymmetry, it means the odds are just fundamentally stacked against you. And that brings us to what might be the single most important line in this whole explainer. It's an old Wall Street saying, and it captures everything perfectly. Don't bring a spreadsheet to a gunfight.
And let's be absolutely clear. Special situations are that gunfight. It is a battle of information, of speed, and of very specialized knowledge. Your standard tools, your spreadsheets, they are just completely outgunned. So what's the big takeaway from all this? It really all comes down to one simple but powerful question you have to ask yourself before you even think about getting involved in one of these trades. What is my edge? What do I know that the rest of the market doesn't? And if you can't answer that question clearly and confidently, the smartest move you can make is to just stay away. Know your edge or stay out of the game.
Okay, just remembering what we mean by special situations. They, I mean, they shouldn't be of interest for us if we are not an industry expert, or if we don't want to buy information from expert networks. So these are situations that we should avoid. But of course, they always come around our investment activities, so we must be aware of what they mean and what we can do about them when we cannot ignore them. But the message in the video, with which I agree totally, is that we should avoid them whenever possible. But I will begin with the first one, which is probably the most tempting one. So we all hear about all these fantastic IPOs and how people get rich by betting on some IPOs. So everyone should, why shouldn't an investor bet on an IPO? That's the basic question. And the reason is quite, in a way, quite simple, is that IPOs are quite a great opportunity if you have the right information, or if you enter you bought the stock before the IPO, because an IPO is a process that usually bets on the following. It bets so let's say the company going to the market hires an investment bank to prepare the IPO, and they pay the investment bank basically to try to do this. So let's say the valuation of the company is this, and this is the day, the IPO date. So what is the expectation of the company? What does the company try to do is that they try to do they try to create expectations so that on the first or second day of trading, but typically in the first hours of trading, the stock jumps. So there is a substantial increase in the price of stock. And indeed, very often that happens. So it's not just a myth, it happens, but not always. Mind you, And the idea of a company, for instance, selling at a price that is apparently undervalued in relation to what the investors are willing to pay on the first day of trading, is to secure a good position for the companies and to allow the investment banks to make money out of the stock they got and so on. But the expectation and what the market shows is that after a while, the price tends to come down, sometimes quite a lot. Sometimes it goes up and sometimes right up. So the expectation is this happens typically within 6 months. So you can take, say, about 3 to 6 months to get to this top. So everyone who wants to buy stocks on IPO are hoping to be able to get out on after the stock tops the price. Unfortunately, that is not happening very often, or very often the investors stay committed to the stock for very long, and they don't realize that the stock will may come down quite significant. And very often, of course, or not very often, but at least from in about 1/3 or so of the IPOs, the stock doesn't follow this expected price. They usually follow something like this. They come down. So this is a typical IPO that is a failure. So the reason why we don't recommend that investors aim for the long future, do not buy on the IPO, even if they want to buy it later on. If they realize the company is actually quite good and it's going to go like this over time, then it's probably better for the investor to buy somewhere here, let's say to buy at this level, and do not risk to face a situation where the stock goes under, because it may take sometimes a few years before the stock actually recovers in a IPO. So, okay, if you realize that the company is a very good one, it's a fantastic opportunity, still the best and the most safe a position is actually to wait until the market calms down and until you realize whether the stock really keeps going up and it's not going down significantly, and then enter that. Because if you are investing for say 5 or 10 years, it doesn't really matter at the price at which you enter. If you enter, say, at 100 or 120 or 130, so it doesn't really affect your return over a period of 5 to 10 years. So if you're a long-term investor, okay, IPOs can be a good opportunity, but you should wait until the company has proven its value in the market, not just the expectations that were built as part of the IPO process. Okay, so it is the one that I think is still worthwhile to a lot of investors. And now let's look at the other cases. Let's consider the turnaround. So turnaround are companies that flop. Basically, you have a company that has flopped. I'm afraid I have to clean some of this. If you have a company that has flopped and has come down quite substantially, and say, let's say a company that declined by more than 40 or 50% or even 60 or 70%. So basically, company was doing somehow well, but then suddenly it comes down to about, let's say, 60% or even more of its value. And you didn't took action, as Sadif recommends, and we'll see it later. You didn't took action when it was just falling minus 30%. So you hesitated. You were hopeful that things would improve, and then the company gets into a really bad situation, and the company decides, or some of the investors, or some of the potential buyers, decide to make a turnaround program and to restructure the company. Sometimes you may even get to keep your stock, but sometimes you may be forced to sell. If the company declares bankruptcy, you'll have to force. So the problem here is that, okay, maybe the company then suddenly goes up, and you could actually reinforce your position when it has lost 60%. But in some cases, you just end up with your stocks worth 0% of what we bought. Why? Because there was a restructuring process, and the lenders kept the whole company and some of the management and so on, and all the shareholders lost all their stock. So there is here a risk situation that you need to assess. Okay, the stock has fallen quite a lot. Now it's a good buying opportunity, or it will still fall more, and I have to really save at least a little bit of my investment. And so this is again a critical decision that you need to consider when you are caught in a situation like this. But you shouldn't probably look for these positions. So let's say if you are in your idea, your search for ideas of investment, you shouldn't deliberately go and look for companies that are in this position, and that where you expect or has been rumored about that will be some kind of restructuring which may save the company, or maybe someone will buy. Of course, some people specialize in this, so basically buying companies in trouble. But this again is a specialist type of investment that a portfolio investor doesn't want involved into the nitty-gritty of what's happening with the company, should not get involved. So unless you are a specialist on this type of investments, you should not get involved in this deliberately. But sometimes you are caught in this type of situations because you simply didn't move fast enough when the company was falling, and you didn't move fast enough. So it happens. Okay. Now let's look at the third possibility, which is so-called spin-offs. A spin-off happens when a company decides to split when management decides to split the company in two or more, but usually two companies, by spinning off part of the business, typically a subsidiary. And in this type of situations, you usually don't have the possibility of avoiding them, because when you realize that that there is some rumors about a possible spin-off and so on, the company announces the spin-off, and of course the price of the above stocks will, especially the stock you own, will be affected by that announcement. So it's one of those events that will cause a major change in the relative prices of both the mother company and the company that is spin-off. So if you are caught in this situation, typically what happens, let's say you have 100 stocks in a particular company. It spins off one of its subsidiaries. It values it at a certain amount of certain value, and they give you a number of shares based on your ownership in the mother company. So in the end, you get up those shares. So basically, you can do one of two things. If you believe on the new spin-off company, okay, you can decide to hold the stock, and you end up having the two stocks, both the mother company and the subsidiary, you have them in your portfolio, and hope for the best in those. Or you don't believe very much on the company, and then you may want to either sell the stock during before the spin-off takes place. You sell some of your own stock in the mother company, or when you get the new stock, you try to sell it as soon as possible, further before, if you think the stock is going down you try to sell it as soon as possible. Let's look at a specific case we have here. It's a recent case. Where is it? Maybe it's in this slide. I don't know which page should it be. I think page 9, I think. Let's look at one specific example that I took from the... Okay, so here we have a typical example of a company. I think for some reason we don't get the full screen. We may need to change this thing. Okay, so you have a company. There's a Honeywell International is a company listed in the stock exchange that recently has spun off one of its subsidiaries and created a new company called the SOLES. So if you look at what happened at the time of the spin-off, after the spin-off, in fact, in this case, both companies performed badly. Not only the mother company, Honeywell here, but also the division that was spun off. So why was the company that was spin off? Why did it went down? So this again, it can be for various reasons. One of them is that the management was too optimistic in the valuation of the company. The company lost the comfort or the support of the mother company, or there was infighting about the new management for the company, or there may be a number of reasons. The fact is that the investors didn't like the new company, or the investors simply consider that the manager of Honeywell was trying to get rid of bad divisions rather than good divisions. So again, the most important assessment you need to do is to try to assess whether the company spun off, or the division spun off, is a good company, or is it a bad company. Unfortunately, the problem is that you don't have too much information about the spun-off company, because it was a division. They don't have they didn't probably publish the accounts separately. In many circumstances, they don't have separate accounts. In other cases, they are separate companies and they have, of course, accounts. So it's really very difficult to judge. Again, one of those special situations where it is difficult to judge if the spun-off company is good or not. And also the impact on the mother company may not be what it was expected. So when management says, okay, they want to concentrate on their core business and so on, there basically is just a lot of wishful thinking. So there's no, it's not sure that spinning off one bad apple will improve the basket in a sense, or their portfolio of businesses. So it's not sure. Again, unless you are a specialist in this type of situations, you better keep away from them. As I said, this is not always the case. Of course, there are cases when the new spin-off really took off rather than fall off, but those are much fewer than this type of cases. So they happen, and usually the critical thing to look is the management. The manager who moves to the spin-off company or stays in the spin-off company relative to the management who stays in the mother company. And of course, the business of both companies, you have to consider that. But typically, the management is a critical issue. And assessing management in these circumstances is extremely difficult unless you have an in-depth knowledge of the people who will take over both companies after the spin-off. Okay, again, it's not the typical investment that you an armchair type of investor would look for. So, but you may be forced to look them, as I said, because suddenly you'll have a stock who announces that they are going to spin off some division. You didn't realize that. You were not paying attention, and you are caught in a situation like that, and you have to make up your mind. So, for instance, in the first days of the spin-off, whether you should, or there is a surge here, whether you should look into that or not. So that's something you need to consider. Okay, going to the last case, I think we have here in our special situations list, although we are already a bit on the... Okay, we have mergers and acquisitions and the takeovers. So M&A, especially takeovers. So takeovers are also a special situation because you face the following. So if, let's say, if your company you own is the target of a takeover, whether the takeover is friendly or it is hostile takeover, you have to try to figure out what are the consequences of that takeover. And the important thing here is to look at the price that is being talked about, and to see if the price really is a fair price, if it's based on a fair distribution of the potential gains of the merger or the subsequent merger, if it's a fair deal that benefits both the investors of the acquiring company or the company that is being bought. So you have to look at that. So there are some ways to try to calculate that using financial models and so on. You may try to work that out, but there is typically a difficulty with assessing the so-called synergies, because the price is usually defined or calculated on the basis of expected synergies. And based on those synergies, which may be real or wishful thinking, and that's where the difficulty arises. So because, of course, the management, the supporters of the merger and the takeover will build the case for all positive synergies, but synergies can be both positive and negative. What counts is the net effect of the two types of synergies. So this is something again that you need to use some tools to try to understand that takeover bid. So you need to take that into account. Again, you have here during takeovers, there is also a specific type of strategies that usually have some impact on the prices of the two companies, and these are so-called statistical arbitrage. If you want to do statistical arbitrage, that's an opportunity to take to do that. In what does it mean, statistical arbitrage? It means that you can there is a divergence between the script that is issued during the takeover period. Let's say the takeover is announced today, and the merger will take it will be time plus n. So in the time that during the time that the merger is under discussion and goes through the regulatory process and all that, so the script that is issued at the beginning may trade substantially different or at a price that is different from the one that would be that is implied in the price offer during the merger proposition. So if the price is divergent, if it's below the price that you can make, if you can buy the future stock, at a lower price than if you were going to buy it from the start, then you may eventually have some gains to good there. The risk of a statistical arbitrage, of course, you only take a position, arbitrage position, if the price is favorable to you. If the price favorable to you, take arbitrage position. Then the reason why it is not arbitrage in the sense that there is no risk. There is some risk, and we call it statistical risk, because there is a risk that the deal is broken, so the merger doesn't take place. And if the merger doesn't take place, you cannot run out of your position sufficiently fast to avoid losing money. So that's why it's called statistical. You have to look at the likelihood of the deal failing, and based on that likelihood, then you can calculate whether it is profitable or not. So, but the fact that during a takeover there is the creation of these arbitrage opportunities, so the arbitragists or the people involved in statistical arbitrage will influence very much the price of the two stocks. Again, some people want to specialize in this type of transactions, and then if they are specialists, they can make money in some of them. But again, not a game for the armchair investor that we are talking about here. Okay. All right. Let's see if we can now just give the opportunity to. Oh, no, sorry, I forgot something more, but we are a little bit late already in this presentation. We forgot about, maybe you can take it over there, but we forgot about the problem with these turnarounds, and especially the takeovers, is that the companies may pay an excessive price, and then they end up with a lot of goodwill in their books, and that goodwill some of that goodwill will typically have to be written off at some stage, and that may impair substantially the position of the company. And that's why it's very important that when you look at the accounts of a company, you look at the percentage of goodwill in of that company as the percentage of total assets. And you'll see that some companies have huge amounts of goodwill, others have much less goodwill in their books, but more or less every company who does acquisitions have some goodwill in their books. The problem is that much of that goodwill has to be, some of it, if it's too much, and it's the result of a bad acquisition, then the company may suffer with that. And there are companies that are good at building, growing through acquisitions, and there are companies that are not that good. I mean, let's look at two examples. For instance, Microsoft is famous for basically killing all the business they buy. So they bought, they tried to enter into the telephone business, but the Finnish company was a leader in the phone market. They just had to write it off. They bought also, for instance, they bought Skype and replaced it with the Teams that we are using. Again, they killed the Skype and came with a product that was much better. So it's a company that has a lot of goodwill in its books, but it's also a company famous for having to do a lot of write-offs because of the bad acquisitions they do. While on the contrary, some companies are better at making acquisitions. Take the case of Facebook, now it's called Meta. When they bought, for instance, Instagram, everyone is saying that they paid a lot of money for it, but it turned out to be a very good cash machine. So they end up, now they have in their books much less goodwill than, for instance, Meta has in not Meta, sorry, the Microsoft has in its books. So that's why looking at goodwill is really important, but we cannot avoid trying to look a little bit down and look at past transactions to see whether the company has been successful in acquisitions, or it was just a process of growing at any cost, and with the losses coming in later to kill the company.